I mean, commissions used to be, gosh, more than 10 times what they are now. The commissions that I pay in a retail trading account are about the same as what I paid as a professional trader when I traded on the trading floor. Commissions, they're kind of the least of your worries. Honestly, most traders don't even realize that they're paying commissions because they're just so darn small. There's a bigger cost, a much bigger cost that's so much more important to pay attention to.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 54, Managing Trading Expenses Like a Boss. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. First, make sure you're subscribed to the show in your favorite podcast app. You don't want to miss anything. And if you're already subscribed to the show, you can go even deeper and get more out of what we talk about with a paid subscription. With your paid subscription, you'll get video extra podcast episodes so you can get hands-on video training on things we talk about on the show. You'll get subscriber-only posts where I drill down on a stock, event, or trading opportunity and share trade ideas. You'll get all my covered call and cash-secured put trades that I'm making in my real brokerage account. You'll get access to our monthly online Ask Me Anything webinar, and you'll get our unusual options activity alerts on options income trades and much more. And the best part is your paid subscription helps keep this show on the air. So I'd like to take a minute and thank our newest paid subscribers this week. A big warm welcome and thank you to Angela J. and Carl H. To join the list of Wealth Building paid subscribers, just go to the Wealth Building with Options Substack page and sign up. The shortcut link to that page is wealthbuildingpodcast.com. That's wealthbuildingpodcast.com. And then choose a monthly or annual subscription. Or for the best value, become an all-in wealth builder and get everything I mentioned, plus our Friday group coaching, our Smart Income video class, and get on the wait list for a signed copy of my new book, Build Consistent Wealth with Options, scheduled for release on April 28th of 2026. When I mentioned that your paid subscription helps keep this show on the air, I mean that it helps pay for the expenses the show has. Everything costs money. We have our producer and editor who work hard on the show, the hardware and software necessary to actually make recording it and publishing it possible. Look, any business or hobby, and well, let's face it, this show is more of a hobby, or maybe a better word is a passion project. But any business or hobby or a passion project costs money. And trading, which could be a business or a hobby or a passion project, is no different. Last week, we started to get into trading expenses. We started with the after-the-fact expense of taxes. Yeah, you can do some planning in advance for sure, but you deal with it after the fact, come tax time. But today, we're going to get into the before-the-fact expense of commission management and then slippage and liquidity, which is managed at the time you make the trade. I have a lot to say about that latter one. So we'll get started on it on this episode, and continue to talk more about it as we continue on with future episodes. So without further ado, let's ask our talented and hardworking show editor, Eric, who our amazing paid subscribers help to support, to add in our usual sound effect. Eric, please add the flash sound effect for the nice people. Your broker cares about you and wants you to make money. It really is true. It really is. Now, don't get too excited. It's not personal. They like you as a customer. You know, kind of like, I like you as a friend. They like you as a customer. Look, your broker is in business. Your broker wants you to remain a customer so that you can keep paying them commissions over and over for as long as and as much as possible. In the same vein, traders and brokers, so you and your broker, have the same objective. You're in perfect alignment. As in any other business relationship, the more profitable of a customer you are to the business, the greater your potential bargaining power is. So I like to remind people, look, every now and then, I don't know exactly how often, maybe every 6 months or so, or when you notice that you've been trading more than you usually do, it doesn't hurt to get on the phone with or get on chat with one of the customer service representatives from the brokerage firm and just have a little chat about your commission structure. Maybe see if they can cut you a deal, grant you lower commissions, maybe even throw in a couple of free ones. It never hurts to ask. And the more you trade, the more likely it is that your broker is going to work with you and grant you a lower commission rate. Commissions matter. And you also have exchange fees too. Those come into play as well. Those things matter. But look, they're pretty darn small. I mean, commissions used to be, gosh, more than 10 times what they are now. The commissions that I pay in a retail trading account are about the same as what I paid as a professional trader when I traded on the trading floor. Commissions, they're kind of the least of your worries. Honestly, most traders don't even realize that they're paying commissions because they're just so darn small. There's a bigger cost, a much bigger cost that's so much more important to pay attention to. And that is the cost of slippage, which is in part anyway, a function of liquidity. Last I checked, there were over 4,500 stocks or ETFs that have options listed on them. Holy cow, that's a lot. But it might be surprising, or maybe not, that really only a handful of stocks and ETFs have options that are actually really liquid, that have tight bid-ask spreads, that have deep bid-ask spreads. Then there are the second tier ones that have, okay liquidity. But of that over 4,500 stocks and ETFs that have options listed on them, for most of them, the liquidity really isn't very good. Low liquidity can seemingly be a deal breaker for any option trading system, but it doesn't have to be. With proper technique and a little planning, it's possible to use the wheel strategy in all but the lowest options classes based on liquidity. For the rest of this episode, we're going to explore the concepts at play in liquidity or lack of liquidity. And we're going to discover how to overcome the issues of illiquidity as best an investor can. I have given the guidance several episodes ago that it's most ideal to limit any trading in options, wheel trading or otherwise, to options classes where the bid-ask spread meets what I call the 10% rule. The 10% rule is where the options offer or ask is no more than 10% higher than the bid. So if the bid is $1, the offer should not be more than $1.10. Okay? It shouldn't be more than 10% wide based on the bid price. And this is important. I'm not just talking about the specific option at the specific expiration and strike that you're thinking about trading. For best results, I want to see most of the near the money and out of the money strikes in all the option expirations under 30 days meeting that rule, unless it's expiration that just got listed like this morning or something like that. We want the norm to be all or most of the options comply with the 10% rule, because we might be rolling or adjusting or rolling into a spread or something like that. So we want that to be the norm, not just, oh, look, this one's the 10% rule, but the rest of them, you can drive a truck through the bid-ask spread. To me, for most wheel traders who a lot of us trade 1 lots or 2 lots or 5 lots, maybe 10 lots. For most of us, that's really all we need to care about. But for traders who trade bigger, or if you want to look a little bit deeper into it, there is another market clue, and that is the size of the bid-ask spread, or the market's size. For most options-friendly trading platforms, it's possible to see exactly how many contracts are bid at the displayed bid price or offered at the displayed ask price. Size reinforces market width. So here's what I mean. If the number of contracts that are on the bid or on the offer is only in like the low single digits for most of the options listed on that stock or ETF, or even if they're just in like the low teens sometimes, that can indicate that there's not a lot of interest. There's not a lot of people who are trading it. And so that means that it can be harder to sell much above the bid or buy much below the offer. And again, this is especially true for investors who are slinging 20 lots or 50 lots or something like that. But if the size displayed is a lot more, in like the higher double digits, there's 50 on the bid, 90 on the offer, that kind of thing, or especially if they're in the hundreds, that's better. That is a great sign that there is probably a lot more people trading it, and therefore a lot more what? Competition. I'm going to tell you something. The financial markets is one of the most competitive businesses in the world. Market makers, which we also call dealers these days, they are in fierce competition with one another. And because of that, they like to get in front of the other person so that they can get the trade instead of somebody else. They're more likely to step up and pay above the currently displayed bid or sell below the currently displayed offer so that they can get the trade instead of their competition. We see that happening a lot more when there is a lot of size, typically on the bids and the asks. Now, there's another thing we can look at as well, which goes along with it. We can look at the volume and open interest. Let's do a little defining of terms here. In options, volume is the number of contracts that traded during the day today, and it's displayed for each individual options contract. So, for example, the Verizon March 50 calls might have a volume of 1,843 contracts. The April 50 calls might have a volume of 82 contracts. Those numbers are a running total of how many of those very specific contracts, that strike, that expiration, that traded on a single day, today, in that series. So then when the market closes at some time during the evening, like 8 o'clock at night or something like that, they erase all the volume, and the next morning, the volume for all options, all of them, starts again at 0. And then that day, they increase as every contract that's traded gets added. And it gets added pretty much real time. Open interest is something a little bit different, and it's important to understand the difference. Because options are contracts, literally contracts between two parties, well, when a contract is created, which means one person buys the contract to open a position, as another person sells the contract to open a position, which is typically a trader and a market maker. One's buying, one's selling. The open interest increases, but it kind of works a little bit different. Open interest is the number of contracts that have been opened thus far and have not yet been closed. So not necessarily today, it could have been opened yesterday or last week or last month or last year if it's a leaps. It's a continuous count that does not reset every day to 0. And on top of that, open interest is not updated during the day for some weird reason. I don't really know why. I mean, I can understand back in the day before we had computerized trading like 20 years ago, that probably made sense. But now it's just kind of weird that it's not updated during the day. It's only updated once each day, which happens at some point, again, in the evening, and it's reflected on the market open. So when the market opens, there's what the open interest is as of right now, taking into account any changes that happened yesterday. And it's going to stay that way all day. Volume will increase throughout the day, but open interest will stay the same all day and only change tomorrow. So, for example, imagine it's a Monday today, right? And options that expire on April 17th become listed on Verizon. Today's the first day that these options are able to trade. So the open interest starts out at 0 for every option listed in that expiration. And so does the volume also, right? Because nothing traded yet today. The market's just opening. Let's say that an investor sells 10 of those Verizon April 17th 55 calls as part of a covered call, for example. Okay. Who is that investor selling them to? Well, most likely a market maker. So maybe the investor sells a 2 lot The market maker buys a 2-lot. It's the first day they're trading. The market maker wouldn't have had a position in there. Both parties are entering into a new trade. It's a buy to open and a sell to open transaction. So now there are two contracts that have been created in that specific option. The investor is short 2 of them and the market maker is long 2 of them. The volume also is 2 for that day as well. So what are we going to see in the volume and open interest? Well, we're going to see 2 in the volume column as soon as the trade is done, but open interest is going to stay 0. Tomorrow morning, volume resets and it's going to be 0, but open interest will be reflected and it will show 2. On later trading days, as contracts continue to be created, opened, or closed, the open interest fluctuates. So the next day, maybe some other trader buys 5 of those same Verizon April 17th 55 calls. And a different market maker who doesn't have a position in them sells to open. And so now the open interest would go up to 7, which wouldn't be reflected that day. Only 5 would be reflected in the volume column that day. But the next morning, volume resets to 0 and open interest will now show 7. But then as trading continues, maybe the market maker who's long them sells them to somebody else. And maybe that's a new person. And if that happens, then the market maker is closing the position and this new person is opening them. So that doesn't affect the open interest. But if one person is closing and the other person is closing, then open interest will get smaller. I know. I get it. It's kind of weird. It's kind of confusing, but it's really not once you start thinking about it. Anywho, the more volume and open interest that there is, that means there's more trading going on. That means you can expect more liquidity out of that options series and that options class. And again, series is like the specific option. The Verizon April 17th 55 calls is a series. The option class is Verizon options. When volume and open interest are higher, there's going to be greater liquidity in all of the series listed on that class. Or at least, all the ones that don't have a lot of time until expiration, like less than 30 days, and are close to the money. That's where you get your greatest liquidity. And I say that, and that brings up kind of an interesting point. Volume and open interest, they're not distributed like super evenly on any given day among all the available options in a class. It could be that today there's a whole ton of options that trade in the March 20th expiration 50 puts. Somebody buys like 10,000 of them, but nothing major trades in the other expirations. Or it could be a really busy day where the market's going down and there's a lot of trading all across the market, and it's just a lot of volume all across the board. So what some people will also do is look at the average daily volume. That kind of smooths out the data. Sure, I'm looking at the volume today, but is this how it usually is? I don't know. If I look at the average daily volume, well, that's going to help a bunch. Although a little bit of a problem with that is that it's not a very ubiquitous figure. There are some vendors that sell raw options data, including volume, and it can be downloaded and put in a spreadsheet and manipulate it and all that business to calculate the average daily volume. And there are a small handful of websites that charge you for it. It's behind a paywall. And all the information's easy to read, readily calculated. But even with the average daily volume in hand, there are some underlyings that have options that show heavy volume, but still have wide or tough to middle option markets. And then there are some that have lower average daily volume, but they're easier to execute options. There really isn't an exact science to it. There's not an exact science to determining whether an option is going to have acceptable liquidity to you. But these tools that I just described, they're going to help. So look at them. Liquidity analysis, it's a pretty important thing because the more liquid an option is, the lower the cost of what we call slippage. Slippage is actually the biggest cost to any option trader. And the best way to think about slippage is consider the real value of any option to be what market makers will call the theoretical value. The theoretical value is what the market maker considers the option to be worth, and it's somewhere between the bid and the ask, because market makers need to sell options for more than theoretical value and buy them for less than theoretical value. So they set their offers above the theoretical and set their bids below the theoretical. And then if they make a trade on their bid or their offer, they make a theoretical profit, which counterintuitively is the important thing to market makers. In the course of opening and closing options, the theoretical profits ultimately become real profits. So when a non-market maker sells an option below theoretical value or buys it above theoretical value, a non-market maker, you're incurring a cost that is not super obvious. You kind of don't even realize it. That cost is called slippage. The further above the theoretical value paid for the option, or the further below theoretical value, the greater the cost of slippage. So how do we reduce the cost of slippage? Well, trade closer to the theoretical value, trade closer to the middle. We need to find ways to sell as much above the bid as possible or buy as much below the offer as possible. That is called middling the market. And that, my friends, is a super important skill to have. And that, my friends, is what we're going to talk about on the next show. And that about wraps it up for this show. But before you go, please make sure you're subscribed on your favorite podcast platform, whether it's Spotify, Apple Podcasts, whatever it is, YouTube. And if you would be so kind as to leave a comment, I would surely appreciate it. Let me know what you like about the show or what you'd like to hear more of. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.